On February 4th, something happened in Washington that caught most investors completely off guard. And if you own silver or have been watching this market, you need to understand what just changed because the implications are massive. Vice President JD Vance stood before representatives from 55 countries at the State Department and announced that the United States will establish a system of price floors for critical minerals using adjustable tariffs. And for the first time in American history, silver is officially on that critical minerals list. This wasn't a casual mention in a press release or a vague policy aspiration buried in committee recommendations. This was the Vice President of the United States making a formal announcement to foreign ministers and trade officials from more than 50 nations about fundamental changes to how America approaches strategic commodity markets. The European Union, Japan, and Mexico have already signed agreements to cooperate on this framework, according to official statements from the U.S. Trade Representative's Office, meaning this is moving from concept to implementation faster than most market participants realize. Before we dive into what this means for silver prices in your portfolio, hit that like button and subscribe to Chart Chamber because we break down complex market movements into actionable insights you can actually use. And this story is developing so fast that most mainstream outlets are still trying to catch up. Let's start with the facts, because there's been a lot of speculation and, frankly, some wild claims floating around, and our job here at Chart Chamber is to separate signal from noise. On November 7th of last year, the United States Geological Survey published its final 2025 list of critical minerals, and this list expanded from 50 minerals to 60 minerals, adding 10 new entries including silver, copper, uranium, and several others. This designation isn't ceremonial or symbolic. It triggers real policy mechanisms including streamlined permitting for mining projects, eligibility for federal investment programs, potential stockpiling initiatives, and yes, consideration for price support mechanisms. The Energy Act of 2020 defines critical minerals as commodities that are essential to economic or national security, have supply chains vulnerable to disruption, and serve essential functions in manufacturing, where their absence would have significant consequences. Silver qualified on all three counts. According to industry data, the United States imported approximately 64% of its silver consumption in 2024, making it heavily dependent on foreign supply. And that dependency is exactly what these new policies are designed to address. Now let's talk about what happened on February 4th. Vance announced at the Critical Minerals Ministerial that the administration is proposing what he called a preferential trade zone for critical minerals, protected from external disruptions through what he described as enforceable price floors. His exact words, and I'm quoting directly from the State Department transcript, were that the U.S. will establish reference prices for critical minerals at each stage of production. And for members of the preferential zone, these reference prices will operate as a floor maintained through adjustable tariffs to uphold pricing integrity. The European Union, Japan, and Mexico have already agreed to work with the United States on developing these policies according to statements from the U.S. Trade Representative's Office. Now here's where we need to be clear about what this actually means versus what it doesn't mean. This is not a guarantee that silver will never fall below a certain dollar amount. It's not the government promising to buy unlimited quantities at a fixed price. And it's definitely not a mandate that all silver transactions happen at or above a specific threshold. What it represents is a framework where if foreign producers attempt to flood the U.S. market with silver priced below what the administration determines is fair market value, tariffs can be applied to bring the effective import price back up to that reference level. The mechanism relies on the President's existing authority under Section 232 of the Trade Expansion Act, which allows tariffs on imports deemed threats to national security, and critical minerals have already been declared such a threat through an executive order signed in January. This approach is fundamentally different from the individual company price floor discussions that were reported back in January and then seemed to fall apart. What died in those earlier reports was the idea of negotiating one-off deals with individual mining companies, which would have been slow, expensive, politically complicated, and nearly impossible to scale across an entire industry. What emerged instead is a much broader systemic approach, using trade policy tools that are already established and can be applied across an entire trading block. The market hasn't fully processed this shift yet, and that's creating what we think is an interesting opportunity for informed investors to position themselves ahead of the broader market catching on. So why is the government doing this, and why now? The answer has everything to do with supply chain vulnerability and the growing recognition that certain materials are simply too important to national security and economic competitiveness to leave entirely to global market forces. Silver's applications have exploded far beyond its traditional monetary and jewelry roles. Modern photovoltaic solar panels require silver paste for electrical conductivity, and there's currently no commercially viable substitute that matches silver's efficiency at scale. The International Energy Agency projects solar capacity will need to quadruple by 2030 to meet climate goals, and every panel requires silver. Electric vehicles use significantly more silver than traditional combustion engine cars, primarily in electrical systems, battery management, and charging infrastructure. The artificial intelligence boom is driving unprecedented demand for data centers, and high-performance servers use approximately 3 times more silver than conventional servers due to increased thermal management requirements and more complex circuitry. Defense applications, including missile guidance systems, radar equipment, naval electronics, and satellite communications, all rely heavily on silver's unique combination of electrical conductivity, thermal performance, and reliability in extreme conditions. Here's where the supply situation gets really interesting, and why government policymakers are paying such close attention to this market. According to the Silver Institute's latest World Silver Survey, the global silver market has been in deficit for 5 consecutive years from 2021 through 2025. A deficit means global consumption exceeded mine production, and you can't sustain that indefinitely without drawing down existing stockpiles. The cumulative deficit over those 5 years totals approximately 820 million ounces, which represents about 10 months of global mine production. And that metal is gone. It's been consumed in solar panels and electronics and vehicle wiring, and it's not coming back to the market. Unlike gold, where most of the metal ever mined still exists in some form, whether jewelry, bars, or central bank reserves, industrial silver gets used up and destroyed in applications where recovery is economically impractical. When a solar panel reaches end of life after 25 years, the silver in that panel is effectively lost, dispersed in landfills, or mixed with other materials in ways that make extraction prohibitively expensive. The 2025 deficit alone was estimated at 95 million ounces, even after a modest decline in some industrial demand categories. Mine production has been essentially flat, with global output around 813 million ounces in 2025, barely changed from previous years. Here's a critical point that many investors miss. Approximately 71% of mined silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means higher silver prices don't automatically result in more silver production the way they would for a primary metal. If copper demand is weak, copper mines slow down, and silver production falls as a consequence regardless of how high silver prices climb. There's no easy supply response mechanism, no switch to flip that brings more metal to market quickly when demand surges. On the demand side, industrial consumption accounts for more than half of total silver demand, and that percentage has been growing. Photovoltaic applications alone consumed an estimated 200 million ounces in 2025, according to industry surveys. The electronics sector, automotive applications, and other industrial uses combined for hundreds of millions more ounces. Investment demand, through exchange-traded products, saw significant inflows during 2025, with holdings rising by roughly 18% through early November, adding approximately 187 million ounces of demand. When you combine structural industrial demand growth with periodic surges in investment demand and a supply base that can't respond quickly, you get the conditions for sustained upward price pressure, and that's exactly what we've been witnessing. Silver prices reflect these fundamental tensions. The metal started 2025 trading around $31 per ounce, and by late October had reached a record high of approximately $54 per ounce, according to widely reported spot prices. That represented a gain of more than 70% year-to-date, outperforming gold, platinum, and major equity indices. Prices have remained elevated even after some profit-taking and consolidation, trading in the $70 to $90 range in early 2026, depending on which source you're citing and which contract you're looking at. The volatility has been significant, with sharp moves in both directions. And this is where we need to have an honest conversation about risk, because while the fundamentals look supportive, this is not a one-way trade, and anyone who tells you otherwise is not being straight with you. There's a metric that experienced precious metals traders watch called the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 70 over the past several decades. During periods of market stress, the ratio can spike above 80 or even exceed 100, while during silver rallies, the ratio compresses toward 40 or 30. In late 2025, we saw the ratio compress from levels above 90 down toward the 50 range, as silver staged its powerful rally, telling you that silver was catching up to gold's gains and potentially starting to outperform. This ratio compression is typical in later stages of precious metals bull markets, but it also suggests that some of the easy gains may already be behind us, and future upside might require either gold continuing higher or silver fundamentals becoming even more supportive than they already are. Let me show you what I mean. Different analysts are providing wildly different price targets for silver over the next 12 to 18 months. Citigroup published research suggesting silver could reach $150 per ounce within 3 months, based on supply deficit dynamics and investment flows. Goldman Sachs has been more conservative, projecting an average price in the $85 to $100 range for 2026. On the bearish side, some analysts at JP Morgan have called the recent rally a speculative mania and suggested prices could fall back toward $50 if investment demand reverses. Bank of America ranked silver number 1 for bubble-like dynamics in their analysis of global asset classes, ahead of cryptocurrencies and high-flying tech stocks. The point here is that smart, well-informed professionals looking at the same data are reaching dramatically different conclusions, and that tells you there's genuine uncertainty about where this goes next. Anyone claiming they know for certain where silver will be in 6 months is selling you something, not giving you analysis. Now let's talk about Project Vault, because this is the other major piece of the puzzle that happened just 2 days before the Vance announcement. On February 2nd, President Trump announced the creation of what the administration is calling Project Vault, a $12 billion critical mineral stockpile. The structure combines a $10 billion loan from the U.S. Export-Import Bank with approximately $1.67 billion in private capital that was reportedly oversubscribed, meaning more companies wanted to participate than there was room for in the initial tranche. The participating companies include General Motors, Boeing, Stellantis, Corning, GE Vernova, and notably Google, with commodity trading firms Hartree Partners, Traxys, and Mercuria handling the physical logistics of procurement and storage. Under the reported structure, manufacturers commit to purchasing set quantities of critical minerals at fixed prices, gaining guaranteed access to supply during disruptions, and agreeing to repurchase equivalent amounts at the same price in the future to replenish the stockpile. This creates a buffer against supply shocks while theoretically providing price stability for both producers and consumers. Why is Google, a technology company that doesn't make cars or missiles, investing in a critical mineral stockpile? Because Google builds massive data centers to power its cloud computing and artificial intelligence operations, and those data centers consume enormous quantities of silver in their server infrastructure. If silver supply gets disrupted or prices spike to levels that make data center construction economically unfeasible, that's an existential threat to Google's growth plans. When tech giants start stockpiling industrial metals alongside defense contractors, that tells you something about how these companies view supply chain risk. And it's worth paying attention to what major corporations do with billions of dollars, even more than what they say in earnings calls. So what does all this mean for silver investors? And more importantly, what should you actually do with this information? Let's start with what we know with high confidence. Silver is now officially designated a critical mineral by the U.S. government, which is a new development with real policy implications. A framework for price floors maintained through tariffs has been announced, and multiple countries have agreed to participate in developing it. Those specific reference prices haven't been disclosed yet. A $12 billion stockpile initiative is underway with participation from major manufacturers who are committing real capital, not just expressing interest. Global supply deficits have persisted for 5 consecutive years, and mine supply growth remains constrained by the byproduct nature of most silver production. Industrial demand from solar, electric vehicles, data centers, and other technology applications continues to grow as these sectors expand. Here's what we don't know and where uncertainty remains. We don't know what specific price levels will be set as floors if and when this policy is fully implemented. We don't know how other major silver producers like China will respond to these trade block arrangements. We don't know whether investment demand, which has been a major driver of recent price strength, will continue at current levels or reverse if macro conditions change. We don't know how quickly industrial users will succeed in reducing silver intensity per unit through efficiency, improvements, or substitution, which several solar panel manufacturers are actively working on. We don't know whether a global economic slowdown could overwhelm these supportive factors by crushing industrial demand faster than policy mechanisms can stabilize prices. For investors, this setup presents both opportunities and risks that need to be carefully weighed against your individual circumstances, risk tolerance, and investment timeline. On the opportunity side, if the structural deficit persists and industrial demand continues growing while supply remains constrained, even modest increases in investment demand could drive prices significantly higher from current levels. The policy framework being established potentially puts a floor under downside risk in a way that hasn't existed historically for silver, though we won't know where that floor actually is until it's tested. Major institutions are clearly positioning for higher prices and supply constraints, as evidenced by Project Vault and the stockpiling behavior. If gold continues its own bull market, silver historically tends to leverage those moves on the upside, often outperforming gold in percentage terms during precious metals rallies. On the risk side, silver is notoriously volatile, and recent price action has demonstrated that moves of 20% or more in either direction can happen in days, not weeks. If you're using leverage or derivatives, you can get completely wiped out, even if your directional thesis is ultimately correct, if you get the timing wrong or don't have enough staying power to weather volatility. Government policies can and do change, sometimes abruptly, and what looks like support today could evaporate if political priorities shift. Industrial demand is cyclical and heavily exposed to economic conditions. If we enter a recession that suppresses construction, vehicle sales, and technology investment, silver demand could fall sharply, regardless of what policy frameworks are in place. The mining industry does respond to price signals over time, and while supply can't increase overnight, sustained high prices will eventually incentivize more production, which could moderate prices in the medium term. A significant portion of silver demand comes from China, and escalating trade tensions could disrupt demand patterns in ways that are difficult to predict. So, what's the takeaway for Chart Chamber viewers? If you're interested in silver as part of a diversified portfolio, this is genuinely one of the most interesting fundamental setups we've seen in years. The combination of structural supply deficits, growing industrial demand, and now explicit government policy support through critical mineral designation and potential price floors creates a scenario where the risk-reward may be tilted in favor of long-term holders. Emphasis on maybe because nothing is guaranteed. If you're going to allocate capital to silver, the smart approach in our view is position sizing that lets you participate in potential upside without exposing yourself to catastrophic losses if we're wrong about the direction or timing. That means avoiding excessive leverage, not betting money you'll need in the next 12 to 24 months, and accepting that volatility is part of the package. Physical silver in the form of coins or bars gives you direct exposure without counterparty risk, but comes with storage and insurance considerations. Silver mining stocks provide a leveraged exposure to silver prices, but add company-specific risks around management, operations, and jurisdiction. Exchange-traded funds offer liquidity and ease of access, but you need to understand whether you're holding paper claims or physically backed instruments. For traders, this volatility is creating opportunities for those who can stomach the swings and have the risk management discipline to use stops and position limits. For long-term investors, the fundamental case looks increasingly interesting, but it absolutely requires conviction and patience to ride out inevitable pullbacks. And for anyone on the sidelines, staying informed about how this develops is critical, because when policy frameworks like this are established, the market eventually reprices to reflect the new reality, but that repricing doesn't happen in a straight line, and it doesn't happen all at once. Now, there's another critical piece of this puzzle that we haven't fully addressed yet, and that's what's happening with China. On January 1st of this year, China implemented new export restrictions on silver that fundamentally changed the global supply landscape. Under the new rules, only 44 companies in the entire country qualify for silver export licenses, down from hundreds of smaller refiners and traders who had been supplying the global market for decades. China controls an estimated 60 to 70% of the world's refined silver supply, according to industry estimates. Not necessarily mine production, but the refining and processing capacity that turns raw ore into the bars and granules that manufacturers actually use. Chinese state media described this policy shift using very specific language. They said it was upgrading silver from a common commodity to a strategic resource, the exact same phrasing used before China restricted rare earth element exports back in 2010. The timing is not coincidental. Chinese export restrictions went into effect January 1st, Project Vault was announced February 2nd, and the Vance price floor announcement came February 4th. This is move and counter-move in what's shaping up to be a long-term competition over control of strategic commodity supply chains. China looks at silver and sees a metal critical to Western green energy transitions, electric vehicle production, and defense systems, maintaining leverage through control of refining and processing. From the U.S. perspective, allowing that dependency to persist is unacceptable from a national security standpoint. Hence the rapid rollout of Project Vault, the price floor framework, and the broader trading bloc initiative. Both sides are essentially trying to siege each other. China by controlling processing bottlenecks, the U.S. and its allies by controlling access to raw materials and end market demand. For silver investors, this geopolitical dimension adds another layer of complexity, but also another source of potential price support. Even if industrial demand were to soften or investment flows were to reverse, the strategic competition dynamic creates a floor of sorts because both governments have decided this metal is too important to allow market forces alone to determine availability and pricing. Let's talk about what this means for different types of silver market participants. If you're a manufacturer who uses silver in your products, the new policy framework reduces supply disruption risk and provides planning certainty through programs like Project Vault, but it also means potentially higher raw material costs than in a purely free market. For mining companies, especially those in the United States or allied countries, the implications are overwhelmingly positive with streamlined permitting, access to government financing, potential offtake agreements, and price floors that reduce downside risk for new projects. For financial investors, whether trading futures or holding physical metal or mining stocks, you need to understand that the market structure is changing in ways that could alter historical price relationships and volatility patterns. with government price floors potentially reducing downside volatility while leaving upside uncapped. One of the most interesting aspects of this situation is how it's playing out differently than previous precious metals rallies. The Hunt brothers' manipulation in 1979-1980 was driven entirely by financial speculation with no fundamental support. The 2008-2011 rally was driven by monetary concerns and financial demand, but occurred against weaker industrial demand than today. What's different this time is simultaneously strong industrial fundamentals, from genuine technological demand, monetary safe haven demand from inflation concerns, and now explicit government policy support. That's a much more robust foundation than previous rallies, though it may mean different price action, with potentially a higher floor but perhaps a lower ceiling than purely speculative manias achieve. One thing I want to be crystal clear about, because we get questions about this constantly, we're not telling you to mortgage your house and buy silver. We're not promising that prices will triple in the next 6 months, and we're definitely not suggesting that silver is risk-free just because it has government policy support now. Commodities are inherently risky, prices can and do fall, even when fundamentals look great, and timing markets is extraordinarily difficult, even for professionals who do this full-time. What we are saying is that the combination of events we've seen in the past week, the critical mineral designation, the price floor announcement, the Project Vault stockpile, all point to a shift in how the U.S. government and major corporations are thinking about silver from a nice-to-have commodity to a must-have strategic material. That shift has implications that will play out over months and years, not days and weeks. Now let's address some practical questions about adding silver exposure. Physical metal in coins, bars, or rounds gives you direct ownership without counterparty risk, but comes with storage costs, insurance, and wider bid-ask spreads. Exchange-traded funds provide instant liquidity, but you need to understand whether they're backed by physical metal in vaults or use futures and derivatives, which introduces counterparty risk. Silver mining stocks give you leveraged exposure because rising prices flow to bottom lines at higher percentage rates than the metal itself moves, but carry company-specific risks around management, operations, and jurisdiction. For options traders, the current environment creates opportunities but significant risks. And even correct directional bets can lose money if timing is wrong or premiums decay faster than moves materialize. Diversification within precious metals deserves consideration. While silver has unique industrial drivers that gold lacks, the two metals tend to move together during risk-off periods. Holding both provides diversification while maintaining exposure to the broader precious metals thesis. Tax considerations matter too. In the United States, physical precious metals are classified as collectibles, with long-term capital gains taxed at 28%, rather than lower rates for stocks and bonds, significantly impacting after-tax returns, especially in higher tax brackets. None of this makes silver a bad investment, but factor in the tax drag when comparing expected returns to other asset classes. If you found this analysis valuable, make sure you're subscribed to Chart Chamber and hit that notification bell, because we'll be following this story closely as more details emerge about specific price floor levels, which other countries join the trading bloc, and how the market responds over time. Drop a comment and let me know what you think. Are you bullish on silver at current levels? Are you waiting for a pullback to enter? Or do you think this rally has run too far too fast? I read every single comment, and your perspectives help shape what we cover next. The silver market is at an inflection point, and whether you're an active investor or just someone trying to understand how global trade policy impacts commodity markets, this is a story worth paying attention to. We're witnessing a fundamental shift in how governments think about strategic materials, and silver sits right at the center of that shift between its industrial necessity and its monetary heritage. The data suggests something significant is changing in how this market will function going forward. The question is whether you're positioned to benefit from it or whether you'll be watching from the sidelines, wishing you'd acted when the opportunity was clear. Thanks for watching Chart Chamber. Stay informed, stay objective, and we'll see you in the next one.